Hello and welcome back to another video. My name is Jack Revis and today I'm going to break down what dividends are, how they are taxed and why they can be tax efficient options for shareholders. Let's start with the basics. What exactly is a dividend? So a dividend is a payment made by a limited company to its shareholders to distribute the company's profits after paying corporation tax. Essentially, it's a way for shareholders to receive a portion of the company's earnings as a reward for their investment. Dividends are distributed based on the number of shares held. So if you hold more shares, you'll get a larger slice of the dividend pie. But there is a catch. Because dividends are paid out of profits, you can't distribute more than the company is earning. This can trip you up if you are not careful and lead to an overdrawn director's loan account if you take out too much money. We've got a video on that topic, so make sure to check that out and it should be up here somewhere for you to click. Now let's talk taxes. The amount of tax you pay on dividends depends on your total income, which is calculated yearly via a tax return. You can use your personal allowance against your dividend payments. In this tax year, the allowance is £12,570. This is the amount of money, including dividends, you can earn before you start paying income tax. If you use your total personal allowance, you can also apply something called the dividend allowance. This is an additional allowance which reduces your taxable dividends. In the last tax year, 2023/4, the allowance was £1,000. In the current tax year, this has decreased to £500. So how does this all add up? Well, let's crunch some numbers. In our first scenario, your only income is £15,000 in dividends. From this figure, you would take away your personal allowance of £12,570, which leaves you with £2,430 in dividends. You then reduce this by the dividend allowance of £500, which leaves your taxable dividends as £1,930. This is the amount on which you would pay tax. In our second scenario, you have both a salary of £10,000 and dividends of £15,000. Your personal allowance is always deducted from your salary first, which leaves you with £2,570 of your personal allowance remaining. This is then deducted from your dividends, which leaves £12,430. You then deduct the £500 dividend allowance, which makes your taxable dividends as £11,930. The rate at which you pay dividend tax depends on the tax band you fall into, which is based on your total income for the tax year. In both of the examples I just talked about, the total income would fall into the basic rate band, and so dividends would have been taxed at 8.75%. Now here is where it gets interesting. Why are dividends tax efficient? As you saw on the table, dividend tax rates are lower than income tax rates, which makes them an attractive option for directors instead of solely taking a salary from the company. The most tax efficient option is to structure your income with a combination of salary and dividends. As a director, there is no minimum wage threshold that you have to stick to, so you can pay yourself as little as you want through payroll. For tax efficiency, it is recommended to pay yourself a salary up to the employer's national threshold of £9,100 if you are the only person on the company payroll. This is completely tax-free for you and for the company. If you are not the only person on the company payroll, you can claim something called the employment allowance. This is an allowance that nets off your employer's national insurance contributions up to a maximum of £5,000 for the current tax year. If you can claim for this allowance and your total employer's contributions are beneath the threshold, it is the most tax efficient to pay yourself £12,570 for the year. This would not have any personal tax implications, as this is the employee's NI threshold as well as the personal allowance threshold, and any company liabilities would be removed by the employment allowance. In both of these situations, you could then top up your salary with dividends. as long as there is enough profits in the company to cover it. However, if the company is not making enough profits to generate sufficient dividends, it may be worthwhile to put yourself on a higher salary, even though you would pay tax through PAYE on this, to prevent building up an overdrawn director's loan account. This is why we always recommend you talk to your accountant about which combination of incomes would be best for you and your business, as it will change depending on many different factors. And that's a wrap on dividend taxes. If you found this video helpful, be sure to like, comment, and subscribe for more financial tips, and we will see you in our next video.